Morning, I'm Daryl Jones, Director of Research at Hedgeye. Welcome to the Macro Show for January 8th, 2025. I keep getting that wrong. We actually have a day off tomorrow, even though the year just started.
Yeah. I don't really...
Rangers could use a day off.
Oh, they're brutal.
They are in a downward spiral.
They keep making me money. Yeah, as soon as they went up 3-0 yesterday, you just put on the spread bet on DraftKings and you make money. Yeah. Come back, then they lose. Anyway, today's not the day that we want to be anchoring on wins or losses every morning. And thanks to the many of you who are joining us, whether you love me or you hate me or you're going to watch me, at least for a little bit here, because it's free today. And again, what we're really focused on is not anchoring on wins or losses. That's called resulting. You can look that up. What we're focused on is the process, executing on the process. And whether you win, lose, or tie, that's the most important thing. It requires a lot of discipline, certainly requires being apolitical, and requires, most importantly, patience and emotional balance. So first thing that we do in the morning on the macro show is we go through the top 3 things that are moving in all of global macro. We model 50 different countries every single day and all the economic data across asset classes. So we don't just wake up like some old wall yo-yo on CNBC and just do stocks. Yeah, it's just stupid, right? At this point, it's not even dumb, it's worse. We focus on all asset classes, commodities, currencies, fiat currencies in particular is the subject matter of the early look note this morning. Thanks for the kind compliments on that already. I appreciate it. I enjoyed writing it. First on interest rates, we're the only firm to have made the call, quad 4 in Q3. That means interest rates are going down as inflation's going down to quad 2 and 3, in particular quad 3 globally and quad 2 locally here in the USA into January. So again, what that means is that bond yields go to the top end of the range. You keep making money shorting bonds. We're short TLT, for example. Many people have that in their retirement account, and they're down double digits really since we started making that call on the bond market. And you continue to see a series of higher highs and higher lows. So you can see that in the 10-year yield. The red arrow is our quad 4 call. Then we flipped because the data did and the signals did to quad 2. So quad 2, you're going to make higher highs here and higher lows. The higher low on the 10-year yield risk range, please use your risk range product. That's not free this morning. But again, 454, we're all the way up there. That's as low as you can go. And essentially the rate cuts that the street was hoping and begging for have been priced out. You got maybe one left, I think, as the data continues to be reported. They're going to take that one out in May as well. And your 2 Canadians here can talk about taking things out. We'll take them out in the Q&A. So if you have questions on that, fire away. Another important observation, of course, which is perpetuating the inflation acceleration, is oil joining the rally. So again, we're already long natural gas. That's up another 5% this morning. The ticker on that is UNG. But again, this is not new this morning. It's just confirming what we call a bearish to bullish trend reversal. We may or may not have a chart of oil this morning, but you can pull it up yourself, and it looks almost exactly like the 10-year yield chart that Genron just showed. So again, Genron's a lot better than most people on CNBC because he does macro, so he can go back and forth across asset classes and show you all this stuff. And it is what it is. So a broadening, you can see your risk range signal on energy stocks. XLE is back in your risk range product this morning. It's hovering on going bullish. The commodities are definitely bullish. And that's what I have to say about that. Finally, on the VIX, it was an episodic and non-trending. Again, if you're here for free today, I got smoked on the. I'm the only one who lost money, I think, on that. But the VIX move, when it had its second biggest up day ever, day to day, I got smoked on that. So again, that's when I lost some money. I came off my all-time highs. I've been building my pile, my hard-earned capital for 25 years. I came off those highs, and that was largely a function of what we call a VIX spike that was episodic and non-trending. Write that down, episodic and non-trending. The trend actually is for the VIX to go down. So currently, you'd have to get above like 19.5 on front month VIX to change that. What I think is really interesting is that we're going into this this holiday on a Thursday, which we rarely have, and into a jobs report Friday, and then into the inauguration, which on the call this morning, that's the morning research meeting that you can dial into. It's the only one on Wall Street that you can dial into that's actually, never mind that you can actually dial into, never mind it being good. But again, it's all my analysts and from our DC office, JT reminded me this morning, again, he was up on the Hill yesterday. He said, look, expect shock and awe on January the 20th from these guys. And And that's what I expect. I'll be shocked if there isn't shock and awe. So there is a major catalyst that is pending. It has been bullish to date. We'll have to see if it continues to confirm. If the data didn't continue to confirm that, which both the JOLTS did yesterday, ISM Services did yesterday, then I wouldn't be saying this. But again, we do have a series of catalysts and an interesting setup where the VIX could easily go back down towards 13. That's where the low end of the range is, the top end of the range where you buy stocks, not every stock, the stock that's signal strengths, which is another product of ours, the ones that are bullish signal strength, you buy those stocks when the VIX is at the top end of its risk range. And those are your top three things. I don't think most people on CNBC even know what the risk range is.
Probably not.
Do they know what the fiat standard is? Does Andrew Ross Sorkin interview people with this principal point of orientation? Like the thing called central planners, central market planners, central bankers, ruling the world with all their glorious and beloved views, and destroying people's hard-earned capital through the evisceration of fiat currencies? Do they talk about it? The rest of the world's talking about that. That's the result of the U.S. election, the Canadian resignation. It's the result of what's going on in Argentina, and there'll be more countries that continue to vote these people off the island, and that's a very good thing. And the commensurate breakout, again, unbeknownst to most people, was dollars and bitcoins. So we're going to be long that. We understand that. In 25 years of doing this, I've been an analyst, a portfolio manager. Now I'm basically ranting to you as a strategist or whatever you want to call me. I don't care. That's a mucker with an M. All right. It is what it is. It's in 25 years I've not seen a more destabilized global fiat currency market than what I see today, fully loaded with a breakout in global bond yields. So that's what's happening now. The fiat experiment is meeting its maker. It's called inflation. Got it? So the currency goes down. Let's say that you live in Canada or in Europe. Your purchasing power has only gone down for the last 3 months because your currencies have only gone down for the last 3 months. Now, if you live in Zimbabwe or you live in Ethiopia or you live in South Sudan, which I reviewed in the early look, oh yeah, we review it all. It's even worse. It's like triple-digit devaluation of your currency in the last year for some of those places. So again, every day that they print money and deficit spend and your currency goes down, you lose real purchasing power. And people are pissed, really pissed off, and they're as pissed off that the establishment and their media doesn't want to acknowledge it or that they're willfully blind to it than anything else. So again, I think one of the biggest winners here post-US election is independent research, independent media, and that I think we're going to continue to see play out in full throttle, certainly post January the 20th. And again, I'm not a Republican, I'm not a Democrat, I'm not a pump fan. I'm a Canadian, so just take it easy on me for now, right? Canadians are polite, right, Jonesy?
Very polite.
We have that reputation. Do you think it's too much of a generalization?
I think it's probably earned in many ways, but they're getting a little angry with Trump wanting to annex Canada.
The Canadians are getting angry.
Now the Canadian platform, the leader is Canada First.
Yeah.
Pierre Poilievre.
Yeah.
We got the pronunciation right.
Poilievre. Poilievre en français. Yesterday I didn't specifically pronounce it right because I don't have an adoration for politicians. I've actually never voted in my life because I don't like politicians. So think about me in that regard. I'm not like all of you. I don't have to have a political bias. I have a data and research bias. But to be beholden to Pierre Trudeau or the new guy, Poilievre, en français, he's a conservative, huh? And it's like, no, that's not how we roll. We roll with what is the Canadian dollar doing, what is the rate of change data doing in Canada, what is EWC doing, which is the ETF for Canada. That's how we do it, okay? But we will talk about Poilievre.
Yep.
Yeah. Now that one guy yesterday, his feedback was, I can't believe you can't pronounce his name.
By the way, he's not actually French. He's actually Irish. He was adopted.
Well, I'm Irish, and my first language is English.
Now you should like him. He's
Mais je
Irish.
parle français, mais
Irish Canadian.
Yeah, my mom's.
Oh, that's a good point.
My mom's maiden name is Thibouteau, with a little chapeau on the O, if you know how to spell in French. Yeah. Enough of the French. Oh, by the way, short France. That you should do right now. Do that for your family. France is right at the top end of the range. Socialist 101, Euro breaking down. France is re-entering a recession. True story. All right. S&P 500 risk range. Here we go. 58, 57. There's always a place to make some money. So what we try to do here is highlight the upside and downside of the day. Okay, so we do this every day, and again, today's is free, so I just want to make sure you know what you're looking at, as opposed to just like opining about how you'll often hear old wall people and even people on the buy side, well, the market feels like this or looks like this or it's overvalued. It's just bullshit. The market doesn't care. The modern machine doesn't care about your feelings and or opinions on valuation, because what? They're just opinions. What is a rate of change fact? And with 83% batting average across going back, what, 17 years now? So you got minus 0.9% on the downside and plus 2.8% on the upside. So today would be the day, especially if they're red, after we sold a bunch of things 2 days ago on green, where we can start buying some things back. Now you can see me do that in real-time alerts. I buy on red, I sell on green, and I buy more aggressively on red when it's closer to that number, and I sell more aggressively on green when it's closer to that number. That's how we risk manage, so that we're not doing what most of you who are signed up for free today do, which is you chase. You have FOMO, you chase, you get mad when it goes down. You typically are what we call the uninformed volume. Now you can turn this off because now you're insulted. And that's fine. If you're insulted, I want to play against you. Because at the top end of the range, a good decision is to make a sale. And at the low end of the range, I just said what I just said. So we got that set up. It's interesting. The VIX, as I said, the risk range of the VIX is 1361 to 19.11. So again, the top end of the range on the VIX is still inside of what we would call the chop bucket. Anything under 20. All the way down, the VIX could go to 9. I mean, I currently have it going back towards 1361, but again, we're in what we call the investable bucket. So the investable bucket means you can trust, quote unquote, trust until you don't, verify, and then trust that is what it is. Because if that number changes and the top end, and let's say the VIX does what it did, which it goes to like 27 in a day, then that's going to change what I say on the macro show tomorrow, which will not be on because tomorrow's not a market day. Or Friday, which you won't be able to watch if you're watching for free. Okay, so there you go. We reserve the unalienable right to change our mind every single market day. Volume, so when we look at a market, we look at the relationship between price, volume, volatility. Guys, show slide 9. It's called trades, trends, and tails. And then, so if you just isolate the volume component of that, I was just being front-run by Eric himself. You can see that yesterday was a down day on accelerating volume, which is on the margin bearish for that day. That said, the day before that was accelerating volume, back-to-back up days on accelerating volume. So there's been accelerating volume because we're no longer in the holiday period, just FYI on that. Sector studies, we look at this every day because we don't pick the S&P 500. We pick stocks, but we don't pick SPY. That's for, if you want to just pick SPY, you don't get any fees on that, you don't get any subscription dollars. But to pick the sectors of the S&P 500 is the real job. And yesterday was what we call a counter trend day. So the up day was for healthcare, for example. So I was selling some healthcare yesterday, and I'd be buying some tech. I wasn't buying anything yesterday. I was waiting for what I just said, which is lower prices. But I would be buying tech and related exposures. Growth exposures are where I want to be for Quad 2 in the USA, and not small cap, large cap growth exposures. All right, what else we got going on? The MOVE index. So what we also look is not just where's the VIX. Now, I model the volatility of every single thing that ticks. Now, the MOVE index is a broad, it's equivalent to the VIX for the bond market, of course. It actually got rate to trend yesterday, Jonesy. So what that's saying, so bond market volatility is picking up. Now, we own something called PFIX. So it went roof on that yesterday. So we already know that it was picking up, but PFIX can go up a lot more if that closes above trend. So the trend level for the MOVE index is 104. Write it down. Okay? When oil got through trend, it just took off. The reason why I built the model this way is that it front runs what? Your proactively predictable behavior and that of the machine, because it's one and the same thing. Okay, so momentum in volatility is something you have to pay a tremendous amount of attention to, or a particular amount of attention to, because it only matters at the particular points in time where the trend changes. So we'll see what happens there today, but taking out all the rate cuts certainly suffices, and we still have the street high, which I'll get into maybe in the Q&A. We have the street, and I'll do it at 11 o'clock where we do our macro themes presentation, 180 slides, where I'll show we've had the street high on CPI inflation going back to October, okay? And we still have the street highs. So assuming that we continue to be correct, because the currency market and the bond market continues to say that we're correct, and the sector styles of the S&P 500 for that matter, again, utilities have been great shorts, that's rate sensitivity 101, then we would expect to be right on our nowcast, because we have the most accurate inflation nowcast in the world for the US. And that is a fact. Okay? So there you go. Why would the Fed want to use that? I'm wearing black like Jensen even. Maybe I should put some diamonds on and then it'll be cool? No, it's because they're the establishment and they cannot afford us being right. Love that. Disruptors. What else we got going on here? High yield, did you buy any of that? You should have. HYG. I also added HYLS, which is tactical high yield yesterday. HYLS being the ETF to the ETF Pro product. And I obviously had been buying it for the fam alongside CLOs with Jonesy Buds, which you tweeted yesterday. You tweeted you bought it. You finally bought it.
I bought it and I said I like the low vol, high yield, and we haven't actually back tested collateralized loans, but in quad 2 they should do well, right?
So you're going to get the research team to back test it, I bet. Yep. You've already done that.
That's the next step.
What is it, a 8.5 or 9% yield?
Trailing 12 months, it's about 9%. So.
Now, I know Andrew Ross Sorkin's been pitching HYLS and CLOZ all morning on CNBC, so maybe that's the only thing we have in common today, right? Okay, it's not just about stocks, and it's certainly not just about, imagine you're long a 60-40 bond fund, like 90+% of Americans, 95+%. Terrible, terrible. When we buy bonds, we buy the appropriate factor exposures in bonds, in this case high yield credit, that works in quad 2, while treasuries, TLT, don't. Okay. Now, an open question for all of you and for the market. Is it worse that bonds get worse because stocks stop doing less good? Well, the market's already told you that. But now bond yields are at the top end of the range, so that's when people will be most worried about that. You get the feelings, the feels. So again, please be careful at the top and the low end of the risk range on everything that ticks. Now, we'll also just knock down some data here. So we're partnered with Tier 1 Alpha. So we look at the options market very specifically and mathematically. So if you look at, let's just knock down the pins here. If you look at 1 month versus 3 month volatility. I mean, currently this is a risk factor that has certainly given me pregnant pause. That's why I wasn't buying stocks yesterday, because that still is where it is. So again, when the blue line's above the red line, I don't have much more time to spend on that. But maybe we should do gamma. Like, where is gamma? Well, it's negative. So gamma is negative. In other words, the gamma, the flip line is 6,017. Therefore, the price of the S&P 500 being below that means that you have negative gamma. Negative gamma means when the market goes down, it goes down faster. When the market goes up, it goes up faster. What just happened in the last 3 trading days? Exactly that. So again, mathematically derived assumptions on how the market should behave inside of what we call OODA loops: observe, orient, decide, and act. I didn't look at my notes for that, but GVT I might, the gamma volatility throttle. So that thing is, this morning, interesting explanation, and this is more for subscribers because this is getting in the weeds a bit, but it does matter. You know, if you look at that, see the number at the bottom? So the number, the throttle's at -11. The equivalent of that really is 1550 on 10-day realized volatility. Now, 10-day realized volatility. What's realized volatility? Well, VIX is 30-day realized volatility. So this is super short term, much shorter than that. Now, when you put that in context, and thank you, Eric, you know, really what's going on here is what we call Brownian motion. At the top end of the range in the VIX, people will be selling and panic selling. At the low end of the range, they'll be chasing stocks. Now, if you're to go back in the 2 periods that we most recently called big quad 4 events, which is coming into the pandemic in 2020 without knowing anything about pandemics or that it was actually happening, the signal knew, or coming out of 2021, you can see where, where realized volatility explodes and doubles, right? That's not what we're currently seeing. So that's why I'm generally not concerned about buying the damn dips if I'm disciplined and I wait for the low ends of the risk ranges. Comprende? Muchacho? We're talking all different types of language.
I think this is a good chart because I remember being up in Quebec with you in 2020. And this is before we really knew what the pandemic was or what was happening.
Yeah, we were on the minibus.
You had sort of highlighted that volatility or realized volatility was picking up. You started to get more concerned. I remember this specifically. You're getting concerned up there, right? We were.
What was that, February?
We were, of course, coaching and probably drinking too much, but you did flag this before, and then the whole world shut down, hell in a handbasket. But this was kind of early. You're seeing the signals in the volatility.
Yeah, the signals are always front running the reality.
Yeah.
Whether it be a single stock where people have inside information, people in the government or the elites. Oh no, they don't have that. Pelosi, right? The volume's accelerating alongside the price, and the volatility is breaking down. People have inside information. The entirety of my global macro signal, it sniffed out shorting Russia without knowing they were going to invade Ukraine. That was one of the biggest shorts we've ever had. It's picked up on the South Korea Squid Games Part 2 situation that they have going on politically with the economic slowdown. The signal is so much smarter than I'm ever going to be. So if you're still stuck watching pundits whose primary objective is to say to you, and think about this, Jonesy, I am a one-man band guru. I am so fucking smart that I can tell you what's going to happen next, what should happen next, what should or should not happen from a valuation perspective, et cetera, et cetera. I'm not that guy. I'm not that smart. Not even close, right? I need a team. I need a team with machines. I need a big team. We have almost 100 people here. I need models, stochastic models, not the old linear econ models that I learned at Yale. No. That's what I need, and that's what you need. And if you start to figure that out, you're going to be better than the people who are just like, they still want to use their 50-day moving averages, and they want to tell you. And it's okay. Let them be on the other side of our trades, because all this is interconnected, it's nonlinear, and fractally modeling the dimensions of it all, as we would call it, will give you a look-see on where the world's going to be, okay? Look no further than where we said inflation was going to be back in October. Okay, what else? Impact table. Last thing I'd highlight on the Tier 1 Alpha data, we have so much information. Really, if NVIDIA turns around today, the S&P 500 should. I mean, that means 27% of the down day came from one stock. Now, if you go 3 different stocks, that's 40% of the down day. So it was a very concentrated move. It came out of the CES move where people were chasing NVIDIA call options. Yesterday on the open, they bought over 337,000 of the NVIDIA calls that expire on Friday that are 150 calls. NVIDIA closed at 140. So everybody who bought those yesterday chasing, because that's what they do, including the machine and hedge funds alike, they lost money. So that perpetuated the downside into the close. So when people lose money, they stop themselves out, generally speaking, I think, if they're pros. And when they're chasing and it's working, then they're getting paid and they do it even more aggressively again, which is what happened the day before that in NVIDIA. So very interesting inside the OODA loop observation on NVIDIA. In Asia, quickly, it's not just stocks in the USA. I mean, which one of you, be honest, our community's long Singapore, but are you long Singapore? That's a new all-time high, right? Up 1.5%. So why do you care if you're long a 6% position in the Russell 2000, which these chartists have been trying to call a breakout in forever? It's still down like 8% since 2021 when it peaked the Russell. Terrible thing. But you could be long Singapore. Singapore is a very nice place. You can't even chew gum there. It's very clean. Okay? Oh, what a thesis. No, it's not a thesis. It's an exposure. Okay, and that is a fantastic one. We're also long the United Arab Emirates, which continues to go higher. So again, we're not sitting here telling you not to buy stocks. We're just not going to own the stocks that everybody owns all the time. Now, we do own Qs currently, and that's worked out wonderfully, but I digress. I would short South Korea on the open EWY because that had an update and it's approaching the top end of its range. China remains bearish trend. We're still short the Philippines, which has been a great one too, down 3.5% in the last month. Did I say short France en français on the EWQ? Now I said called the words out, the letters out in English, but you got it. We're short that. We'd be shorting more Denmark, which has crashed. Eden is the ETF for that, EDEN, and the Dutch EWN. I'd also add Poland this morning. Let's put the Poles on the line. A lot of emerging market problems out there, okay? With the dollar strength, EPOL is the ETF for that. We've been long it in the past. Now we're going to short it. What else we got going on for you? Commodities. Are you long Singapore? Are you long commodities? Now, these are big components of my family's hard-earned capital. I don't have to win when everybody else wins. I win when I win. You win when you win. That's us. That's preserve and protect the pile. So again, whether it's commodities as an asset class hitting a new cycle high this morning, or Singapore for that matter, these are things that we have in our portfolio that they don't. You will never hear Andrew Ross Sorkin talk about the CRB Commodities Index. Even though you talk about the Dow and points all day long, that's got 30 components, CRB has 19. So again, pay attention to the real world inflation underneath the hood on that. Gold, we're out of that, not short it, not long it. I would short gold miners, GDX. Copper testing trend for copper is around 425, it's at 420. I would look for that to fail because it's near the top end of its range. We're long corn, we're long natural gas, as I pointed out in commodities, just to round out the commentary. And then finally, because I already hit on bond yields at the outset, what I'd say, I mean, if you were on the show yesterday because you paid for it, what did I tell you to do yesterday? What a call. No, it's not a call. It's executing on the process. I said, you better be buying dollars here and shorting pounds, euros, Canadian dollars less aggressively than the other two, yens, South Korean wons, and look what's happening. We're getting paid there too. So we do foreign currencies. That's a real important thing to do, because if you don't get currencies right, you're probably not going to get everything else right, which includes inflation. How do you calculate the inflation? You got to know the currency you're calculating it in, right? Why do these people never talk about these things? I mean, that's why CNBC is the longest running comedy in the history of cable. Like double the amount of years, I think, than Seinfeld. It's amazing. Bitcoin, buying the damn dip, and same thing with Ethereum. We're long those. They're not quite at the low end of the range, so I'm picky. So at the low end of the range, we will get more aggressive, or I will. Whereas if you're in the middle of the range, so Bitcoin, for example, the low end of its range is 92,154. And if it has a 95,000 in front of it, that means it's not at the low end of the range. So I don't get aggressive, but I could buy 25, 50 basis points of my hard-earned capital. That's 0.25 to 0.5% of what I have in the account. Okay, so with that, I'll take some questions.
All right, the first one that we were talking about before the show, but rate cuts. We're now down to basically one cut this year based on Fed funds futures. It's kind of a coin toss, but that's where sort of the...
And it's not like January or March anymore.
Yeah.
It's May.
Yeah, so we have one in May, and a month ago, obviously, it was a very different outlook. We had basically 2 to 3, so they very quickly, based on probably primarily inflation, taken almost 2 cuts out of the market.
Yeah, I mean, the Fed in particular has been dead wrong, and therefore consensus economists, strategists, Wall Street at large has been dead wrong on this multiple times, and both ways, right? So it wasn't long ago that they were expecting 10 rate cuts. They end up getting 4 with a panic cut of 50. If you go 100 basis points 4 times, divided is 25 basis points. So you got that, and I think the market's got it right. I don't think that's very complicated at all.
I guess what could change that maybe is non-farm payrolls Friday. We did get ADP this morning. Again, ADP doesn't always correlate, isn't the best data set, but it did slow sequentially. Came in 122,000 for December, down from 146 in November. So deceleration in that component of employment.
Yeah, and JOLTS was better yesterday, and jobless claims has been better.
JOLTS was better, jobless claims has been low.
So. Yeah, so I mean, to me, the market's going to move on, as long as jobless claims don't break out to the upside, like something north of 300,000 on a trending basis. Yeah. If we don't see that, what we have is basically a fully employed labor force with 6% nominal GDP growth. Don't forget, we have GDP growth accelerating in the current quarter. Just to show that, guys, you can see our GDP nowcast. So again, we don't have a recession. All those people that were betting on a recession and buying TLT, long-term bonds, duration, they just got crushed. I know of 2 major hedge fund managers on platforms yesterday that got fired. Macro guys. One guy hates me. Why? Why does he hate me? Well, I hate his views. If you start hating on the player, you're going to start to lose yourself here. Focus on the data, right? So again, we don't have a recession, Jonesy. We actually have a lot of very big catalysts coming on January the 20th. So something to think about there. I think we had some questions on.
Oh yeah, right. Sorry, let me. I apologize.
Hit on it quickly because I got to go.
Yep.
We have our macro themes presentation, and I have a couple more slides to edit.
Give me 1 second here.
One in particular, I think, was on scaling, position scaling, maybe?
Here it is. Kindly address on the macro show exactly how you scale into a position. I know 25 or 50 basis points at a time, but the pace of scaling is difficult for me. Hours or days to get a starter position question. What factors make you go faster or slower? Your help is greatly appreciated.
Can you put up the position sizing slide, Ethan? The super important question, okay? So this is the number one thing that most of you who are watching this for free will screw up routinely, okay? The people that subscribe screw it up too, but then they screw it up less, and then they finally get some discipline, okay? I'd say 80% of our user base has that discipline. 20% is either new and still learning, or they're still dealing with their old wall baggage selves. And that's a thing. Pisses people off when I say that, but that's okay. It's like, when I see a parent banging on the glass telling their hockey kid what to do, that's bad behavior too. They probably don't like me saying that, but I don't care. It's bad behavior. It's just 101. We want good discipline, good behavior. So if you take something, so these are our max positions per asset class. So when I say foreign currency, my max position in UUP is 12%. Fixed income on something like HYG is 10%. And on something like QQQ, it's 6%. Okay, so again, on commodities, which I include IBIT or Bitcoin, that max would be 4%. Options 1 to 2. Okay, so establish your minimum and your max. Have you done that yet? You should, or you're banging on the glass. You're on tilt. Your positions are too big. You're looking for ideas. You got newsletters. You got this. You got that, and you just don't have a process. That's not a risk management process. I have one. Okay, it's not perfect, but it's better than what I just said by a lot. Now, if you take the question, it really has, let's isolate this, Jonesy. So how do you get into Qs? All right, well, first of all, as soon as I add it, you add it at your minimum position. So my minimum position for Qs is 2%. Why is it 2? Because if I sell some and it keeps going up, I still make something of consequence because the 2% position is of consequence. So again, how do you get from 2 to 6? Now, when I say plus 25 basis points to plus 50 basis points, beeps, basis points of capital, that means 0.25 or 0.5%. So at a minimum, I will never buy less than 25 basis points at a time. Most of the time, if it's equities, I'm buying 50. Most of the times, if it's something like HYG, which I show in Portfolio Solutions every day, by the way, I think about 100 basis points of that, or I should have yesterday, because it was down. So, again, more aggressive because it's a lower beta thing. So you got that, incremental. Now, the pace, the time, what I like about the question in terms of identifying how people might think about it, but the way you shouldn't think about it, is how many days should it take? Well, you don't really get the answer to that question. You'd like to have the answer to that question because it would make it easier. But the real answer to the question is what? You get more aggressive when the market provides you what? The opportunity. So if Qs are at the low end of the range, I don't buy 50 basis points of Qs. I mean, currently, I took my Qs position. It's actually at 2.5%. Right? It was at 6 at the end of December. Then I got paid, sold 50 basis points at a time, and now I'm down to 2.5. Okay? So now what? Did I buy any Qs yesterday? Look at Portfolio Solutions. Nope, they were down. Didn't buy them. But if they're down at the low end of the range today, I'll buy 100 to 150 basis points and get myself towards 3.5 to 4%. And if they're down again the day after that, I'll just keep going. Okay? So when you're closer to the low end of the range, you get more aggressive. When you're in the middle of the range, you nibble a bit, right? And that's how I do it. And again, I don't think that every number that I just put on the page is how you have to do it. Your maximum position might be 7 or 8%, but I can tell you right now, your anxiety is going to go up quite a bit if it's an equity position and that's going on. And I don't need that anxiety in my life. I'm 50 years old. I've been doing it for 25 years. No. For me, that's what it is. So I wouldn't say that these are the written rules of God, certainly, but I would say it's a good framework and starting point for you to battle test. Well, like what if your portfolio is not in a place where you're comfortable with it when it goes up and down, then you got to change the sizes, right? But determine what your rules are, and then your mode of execution or your proactively predictable behavior and the discipline embedded therein. Like, am I executing the way that Keith just said, 25 to 50 basis points in the middle of the range, more aggressive at the low end of the range?
All right, we're going to wrap it up there. Thanks, everybody, for tuning in. Have a great day off tomorrow. We're back at it Friday. Take care.
And good morning from the control room, everybody. I'm producer Eric Gendron. How we doing out there? Thank you for joining us. If you're new today, just a reminder to go to hedgeye.com/research if you want to check out all of our products that we offer. If you are already a Hedgeye subscriber and this is your first time checking out the macro show, you can check out other stuff there. I just want to remind everybody that we also have hedgeyetv.com. A lot of our free content is on there. Some other pay-per-view purchases that can be made on that website as well. A lot of our video content is available there. And then don't forget, most importantly, today, Hit It Marina, we have the macro themes at 11 o'clock, as Keith has been mentioning. So if you are a pro risk manager or macro pro subscriber, don't forget to tune in. If you're not, reach out, scan that code to access it, upgrade today. And we hope to see you at 11 o'clock. Have a good day out there.